I believe it's episode 4, Roast with Rob, hosted by Craig, your host, Craig McGrother, alongside with
Rob Beardsley.
Very good. We are here in Dallas still. We actually had a jam-packed, full day, on set, on camera, hot mics, all day long today, filming a really awesome video like we did for the 3-property portfolio in Houston. I think it's really fun when we get to do that. It's a little bit different. You know, a lot of times you're in the office and you're not really exercising the creative bug that you have and whatnot. So I think it's personally really fun to do that. It gives me the kind of the residential real estate juice that I used to do before. So doing that was a lot of fun for me today, at least. What was your experience like?
Yeah, I love these kind of days where from wake to sleep when we finally get there, it's fully jam-packed. So yeah, it's very productive. And then we finished off the night with a really great broker dinner, closing dinner to celebrate a closing.
Yeah.
So that was great. And hopefully we have many more.
Yeah, absolutely. Great brokers, awesome group here in Dallas. So that was great. And then obviously today we're filming for the newest acquisitions we have coming up, which is 1001 Ross, which is really cool. We're not going to get into many details there, but that was really fun. And then you want to share maybe as well what we were also filming there, which I think is really exciting and will be hopefully, in addition to this podcast, but that could hopefully propel us to the next level in reference to, marketing and really just spreading the word and the message.
Yeah, we're working with our video production team on not just doing these property videos, but also working on some more general evergreen marketing content, sharing more about Lone Star and our thesis and our strategy and what differentiates us as a sponsor, as well as getting to know me a little bit more and kind of opening up a little bit more about myself and sharing more about my journey, my past, my what goes on up here. So hopefully, the goal of that obviously is to touch more people, resonate with folks, attract more investors, deepen relationships, and grow our network.
Yeah, and it's funny because I think you're doing this and timing this really well, where if you did this right away, no one would care because you'd be, at that point 20 or 21 and you just haven't had enough world experience at that point. So probably no one, I would care, your friends would care, but outside of that, it's like, well, you haven't enough experience. But people will care now, considering the fact that we have $350 million of assets under management. We have, $165 million of deals, which is crazy to say. Yes, $165 million worth of deals right now in contract, which is basically spread across 5 properties and 2 MSAs, which is really exciting. So yes, the deals aren't done. They're in contract. They're in escrow. We have a lot of work to do. There's a lot of work that's been done. There's a lot of work we're going to keep doing. So we're going to push it through and make it happen by hook or by crook. So we're excited about that. But yeah, we're excited. It was great. But, to that point, it's going to be really cool for you to kind of share that and, implement a lot of the great, message givers right now, influencers, if you will, like the Alex Hormozis of the world. So I think that the world needs to see that. I think you have a unique skill set for that where, not many people can just have a camera, no prompt, anything like that, and just, kind of just, as they say, spit some bars out. So it's really cool to see. I think you have a unique skill set. It's funny, when I'm trying to do my content and start going there, I really, it's a struggle for me. It's a learning curve that I'm going through right now. So it's really cool to see how you do it, and it's inspiring, but yeah, so it's really good stuff.
Well, you talked about how today we did our second ever property video, and you feel like you've gotten a whole lot better.
Yeah, no, I felt a lot more comfortable. So I'm just looking at my phone for the time. But without further ado...
Also, what did you do with the AC? The AC...
I turned the heat on, actually, to be honest.
The heat's on?
I turned the heat on.
It stinks.
Yeah, and well, that's what happens when the heater has been used. But yeah, no, I felt a lot more comfortable when we're on camera. It's funny, you don't realize what you're doing, your weird mannerisms, if you're too smiley to some people when you talk, if, you look a certain way on camera, how everything looks. I think you watch people on TV, on news, and it's like those are literally, basically actors. They're built for that. Like, that is their job. Like, these people, they do it, and you just assume everyone's like that, and that's very far from it. It is not an easy thing to do. So I think my level of respect for people who are, hosts, for people that are kind of in that realm and world, it's not easy. It's difficult. And if you're on live TV or anything like that, you can't mess up on the spot. Well, you can. You just would look silly. So my level of respect to that line of work is, I tip the cap to that.
Very good.
Yeah. So on to the topic for today, or topics, I should say. What I want to go through right now, and I think you came up with this idea that you want to touch on at some point, so I figure we might as well tonight, is capital calls. So when the market is starting to change, or when a deal goes south, that word will come up. And I think on the investor relations side, many people ask, and one of the first questions that we get asked is, hey, have you ever had to do a capital call? Unfortunately, to this point, the answer is no. But why don't you explain to everyone what a capital call is, what it means, why it's such a red flag and kind of a taboo and trigger word, if you will.
Yeah, a capital call in our industry is when a project is suffering, and in order to right the ship, there needs to be an infusion of cash. So, and that it could be various reasons, but typically speaking, it has something to do with bad operations coupled with some sort of crunch on the debt side of things. So there might be a loan maturing, and there needs to be a cash-in refi. That could be a substantial capital call. It could also be rising interest rates, as we're experiencing now, and a sponsor may need to issue a capital call to their LPs in order to fund debt service. Because if monthly debt service was $50K and now it's $150K, right? That's an unexpected expense in many cases and could lead to the need for additional equity to float the property. So as you can tell, these are all bad circumstances. And
Right.
So a capital call, nobody wants to hear about that because it just means that something is not going well with the property.
Yeah, and it's funny. I think a capital call in the venture capital world is not like, oh, the thing is bad. It's like, no, you're literally just, the VC person, the investment representative. Essentially, you basically soft commit and then you hard commit once the capital calls comes. So different world than what that's in reference to.
Right.
Just to know.
Yeah, in a fund structure, you would invest your commitment, or you would subscribe for your commitment, and then maybe the first 10% or 20% of your investment is called initially. And like you said, then as deals are getting done, the fund manager needs the capital, so they'll make a capital call. So those are routine, those are standard practice in a fund circumstance. But in our business of syndication and real estate private equity, the deal is fully capitalized from the beginning, so there's no planned need for a capital call. So again, it's an unexpected need for additional equity, which usually doesn't bode well.
So what you're saying is this happens when a deal goes south.
Yes, that's right. And some investors, every capital call is different. So some capital calls are mandatory and there's a penalty clause. Other capital calls are optional and there's no penalty. So it's up to the investor to understand the language of the operating agreement and to see if it makes sense for them to meet the call or to pass and potentially be diluted at a pro rata basis or potentially at a penalty dilution rate.
Yes, I was actually going to ask you about that, and I'm happy you get in. So I would really like you to touch on more what happens in a situation where, I guess maybe if it's not optional, it's hoped, is it implied that you have to do it? What happens if you do it? What happens if you don't do it? And then if a capital call is made or needed to be done, is there, maybe potentially another pref position that gets put into the capital stack to kind of do that? So maybe walk us through some of those mechanics.
Yeah, there's a few different ways that a capital call can be structured. As I mentioned, it can be mandatory with a penalty, or it can be optional with no penalty. So let's use, I would say the more common one would be an optional capital call. And let's just take a super simple example. Let's say you and I do a deal together and we each put in $1 million. So the total equity for the deal is $2 million and we're 50-50 owners in the property, right? And let's say something's not going well with the property and there needs to be $1 million capital call. Okay, and let's just say you choose to not meet the capital call. So I fund the capital call, let's just say, completely. Then it's very straightforward, right? Now I will have invested $2 million into the deal. You will have invested $1 million. You'll be diluted on a pro rata basis, so your ownership will go from 50% ownership of the deal
roughly
to 33%
right.
ownership. So in that case, there's not much of an incentive for you to fund your call, right? If you don't, in your perception, want to throw good money after bad, then you don't have to, and you're just going to be diluted, and it's not necessarily at a penalty rate. But let's say there was a penalty rate in our operating agreement, right? And you didn't meet the call, but I did. You might get diluted instead of from 50 to 33%, it might dilute you at a 2x rate or something like that. So you
like
might,
it's like a multiplier, like a negative spiff, if you will.
yeah, exactly. So you
Okay.
might be, it could be at a penalty dilution rate and bring you down to 20%, 17%, whatever the math or mechanics are. So those are things to watch out for and to understand. And I could see a situation where an investor, even with a penalty, may not want to meet the call because maybe they have other needs for that capital, or they don't believe in the deal at all, right? Because at the end of the day, the additional capital that you're investing in the deal is in hopes to be able to fix the issues at the property so you are able to eventually get a positive outcome, whether it be a sale in the future that gets your equity back, or potentially even maybe part of your equity, or even a profit. So if you don't believe in that future, or you don't want to wait for that future, you might just cut your losses now and not meet the call. And then also, as you mentioned, there's other capital calls which aren't technically capital calls, but they really are, but they're structured as essentially loans, right? So a sponsor can go to their LPs and say, the property needs $1 million. We're not going to call equity, we're going to call debt from you. And they can call it a member loan. And so the capital call could be structured as a 10% note that subordinates all the equity. So while technically the existing equity isn't diluted, they are essentially being diluted because they're now subordinated by additional debt.
Interesting. Okay. So in your case, in your experiences, when would be an instance when you would want to make the call, and when would you not want to make the call? Because I've heard that some people say you should never make it under any circumstance because, to your point, you said you don't want to chase good money after bad. And let's say hypothetically, if you're a smaller investor and you invested $100,000 and the capital call is $50,000, would you really want to invest another $50,000 here, or do you want to accept the fact that, hey, if I invested 100, I make it 80 cents on the dollar effectively. So basically my 100 turns into $80,000 and I live to fight another day. And I'll put my $50,000 into a different deal that hopefully maybe you average it out. You'll be net positive on that perhaps in the long run, right? So when would you want to make it and not want to make it? Is it a personal reason why you would or wouldn't, like it's a friendship thing? Or, because there's probably instances where you might say, okay, well, hey, I like this person. Maybe out of the kindness of my heart, I might want to do this. Or, like what would be the reason why, I guess?
I think it just really depends on the numbers and the circumstance and how much you believe in the deal and the sponsor, right? As we always talk about, the sponsor is super important in these situations, especially when things go wrong, right? Everyone's a genius and everyone can manage a deal well when things are going well. And then once things start struggling, that's when you really see who's actually capable of stepping up, dealing with issues, and being gritty. So I think the factors are you need to re-underwrite the deal. Accept the situation for what it is at the moment, underwrite the deal from there and say, okay, what's realistic as far as revenue and expense projections, and what are the terms of the current financing, what are the projections for future financing, what cap rate do we think we can sell at in the future. So that's kind of the property level or the project level underwriting. And then you also need to include in that underwriting the capital call features themselves, right? And you need to look at, okay, well, if there's a dilution rate, then you want to factor that into the equation, right? That now the deal has to maybe not be as good because the dilution could be so draconian that it just makes sense. Even if you don't believe in the deal, the penalty to not meet the call is so bad that you just need to do the call, right? In most cases, that's not the case, but those are just some things to be aware of. But yeah, you're right. I mean, the problem with capital calls is most people don't want to make them, but it's kind of like protecting yourself, but spiting the greater good, right? Because if
To not make the call, essentially.
yeah, because if you want to just not make the call because you want to keep your capital in your pocket and do something else with it,
Or just live to fight and find another deal, right?
sure.
Yeah.
But if all the investors in the deal feel that way and the property literally cannot get the equity it needs, maybe the property gets foreclosed on and you lose your entire investment.
Right.
So it's kind of a funny thing
Darned
where,
if you do, darned if you don't, right?
well, it's kind of like the crowd, right? If everyone else makes the call and you don't, you might be in fine shape, right? But if everyone thinks like you do, then the whole thing falls apart.
And I guess does that fall onto maybe just buying with the sponsor, or does that just have to deal with maybe the deal itself, or like when? I mean, have you heard of instances where the crowd negatively relaxes or reacts, excuse me, as a whole, or have you seen situations on the other end of it where everyone's very positive and it's like, okay, let's just get it done and it's cohesive?
Well, so here's the thing. If the existing LPs don't meet the call, or if there's not enough equity to provide the deal with what it needs to be able to go and right the ship, ideally, the sponsor is going to seek third-party financing, right? They're going to need to get that capital. I mean, a good sponsor is not going to just give up on the deal and ideally, right, and let it just
Die.
let it die. So if they're not able to get the capital call from the existing investors, the sponsor should go and seek outside capital. And so they can find rescue capital from third-party sources, and they can structure new debt or subordinate debt, preferred equity, or some sort of rescue financing, right? So that's kind of your next step. And for some people, maybe that's even the first step because they'd rather avoid the stain of a capital call and they'd rather just pursue the third party, some sort of rescue capital, right? So those are the different options you have at play. Of course, a good sponsor, especially a well-capitalized sponsor, may opt to just fund the deal's needs out of pocket.
Well, it's kind of interesting because I spoke with a couple people recently that were talking about this, and some firms and some sponsors actually over-raise on the deal, which is kind of interesting because, technically you might be able to avoid a capital call if, depending upon your debt profile and, the situation where it's stickier and you're, basically taking the capital to pay that off essentially. But some people over-raise for this reason, which I think is or just overraise generally, and that could be a reason to avoid it, but unfortunately you're kind of eating away at your principal, or basically the equity you put in there, which is definitely not the best, and that definitely obviously hinders returns, right?
Well, there's always a balance to everything, and so you don't want to close a deal with bone dry operating accounts and you're riding on thin ice, right? So you want to have good reserves, but if you over capitalize the deal with too much reserves, it's going to drag on the returns, right? Because effectively you have a lot of money that's not being productive in your deal. So that's a balance, right? So what's the perfect number? I don't know. Every deal is different and everyone's risk tolerance is different. We've been tweaking that over time, and we kind of think that somewhere around 3 months, maybe even 4 months worth of operating expenses and debt service is a great reserve amount to have to deal with the everyday operations and to have extra reserves if things go wrong.
That's a great point that you just put in there, just so people feel safe when they're making these investments, knowing that we're responsible custodians, knowing the fact that we have enough to withstand a storm if things kind of go south, if a recession comes up, if jobs get lost, if occupancy goes down, that we have the ability to address it and make that happen. In a doomsday scenario, though, how long does it take roughly in your experiences and what you see maybe for a bank to actually take a property? Is that a 6-month process? Is that a year? Is it a couple months? What are the fundamentals of that?
It really varies based on the lender and based on the state. So, and I don't have a ton of familiarity with it.
Fortunately.
Yeah. So, yeah, I would. It depends, and also depends. What's the timeline from default, from technical default, from not meeting your debt service coverage ratio covenants. So, I mean, it's kind of a vague question as far as when things start going sideways to foreclosure.
Interesting. So I want to also kind of pull back and go to another thing that you mentioned, which is in the event that a capital comes up, you're going to want to re-underwrite the deal, right? So if you're going to re-underwrite the deal, it sucks because you're at the point, and the investor's at the point where you're probably not happy about this. You probably got sold, a 15 IRR in that kind of range, maybe a 20, depending upon who underwrote the deal and how aggressive they were or were not on the numbers. How does trust come into play? Because you're re-underwriting it under their assumptions, but the funny thing is that you're only in this position because their initial assumptions were obviously not accurate. So if you're, maybe not the most sophisticated person, if you're not someone who's in the weeds and, a pro's pro like you, or maybe someone like myself who has an understanding but might want to call upon someone like yourself, or someone who else is also really sophisticated just to double check the work. How does trust come in there? And is there situations that you've heard where people aren't buying what they're selling? Because obviously the situation's hairy. Do you want to really retrust them again? And as you said, chase. So that's kind of something I was just thinking about and toying with is the trust side of this. Because it's probably to a certain extent maybe not broken, but it's definitely a tough and hairy situation.
It's a tough situation on both sides. And emotions run high when there's money involved and people are losing money or they're scared to lose their money and things like that. So it's all very delicate. But what I will say is, first, talking about investors, this is when it really pays to have savvy investors. The more sophisticated your investors are, the more they get it, right? They're not going to be just mad at you, the sponsor, if, for example, what's happening right now, which is the fastest rise in interest rates in history. And oh, by the way, it came as a shock to the system and it was totally unexpected, right? Everyone got it wrong because if you just look at the charts, the forward curve, which are the projections of the future path of interest rates, projected this to happen with rates. So the brightest minds in the world all were forecasting this.
What does this mean? Because for those who are listening, this is terrible radio. So please explain.
Sure.
So, yeah.
Okay. So the forward curve projected rates to stay flat for a couple years, and then, as we all know, rates over the last year and a half have just hockey sticked and have, like I said, increased.
Historically raised, yes.
They increased at the fastest rate. So that, right, an unsophisticated investor would be banging on your door and be saying, hey, what's going on? Why aren't you giving me my distributions? Why aren't things going well with the property, right? They don't get it. They're tone deaf to the situation, right? A sophisticated investor is going to be very, very understanding about the situation. They might not be happy, but they get it because they're seeing it across their portfolio. They know that it's systemic and it's not just you, this individual sponsor that made some mistake.
Yeah, and it's funny, the unsophisticated investor wants alpha, no downside, and like a 20 IRR, which is, not realistic, right? All the time, of course, and, with no risk or anything like that. And I think one thing you've said so many times, and it really is important, and this is when I'm on investor calls a lot, I really try to figure out their goals and honestly get a gauge with how reasonable they seem to be. I want to work with people that we can say, and like, hey, like if they're expecting the moon, the sun, and the stars, I don't want to work with someone like that, and I don't think they're the right fit for us. Not to say that we're not going to potentially take, capital from them, but if they're thinking one way or a certain way, and I'm kind of hearing dialogue that doesn't sound right, that is for sure a red flag to me.
Totally. So it's funny, right? Because in good times, you may
get penalized for that too, right? Yeah.
Sponsors may want unsophisticated investors because they want to be able to get them in to questionable deals and they want to overcharge them on fees, right? So on the one hand, unsophisticated investors are great. But then if things are going sour, then that's where the unsophisticated investors are going to be potentially 10 times the bigger headache. And meanwhile, the sophisticated investors, they're going to get it. They're going to be on your team. They're going to be collaborative to come to a realistic solution, right? It's all about being solution oriented. So thankfully, I'd say for the most part, we have very sophisticated investors, and when we have run into issues, it's been very collaborative, and we've found a way to have a solution. So that's really great. Now, let me just say on the sponsor side of things, because you talked about trust, right? And so the trust factor is tough in a situation like this because interests are not aligned. And there's various ways that interests don't align in private equity, but specifically in this situation with a capital call and downside scenarios, the biggest factor is a sponsor, number one, doesn't want to make a capital call. Because as you know, what's the question that investors ask you on investor calls all the time?
Have you ever made a capital call?
Right.
Yeah.
Have you ever made a capital call?
And in this environment, if you actually say yes right now, I think for the retail tranche, which is for people listening don't know what that means, like basically your private fund, because there's typically maybe fund managers coming in, capital raising partners, perhaps private equity people, but then your tranche is, your retail capital, if you will, your core group of investors that go into
That's
your
our
deal.
private network. Yeah.
Exactly, your private network, your email list and such. You may have a third of the less people that want to invest, or at least on the new investor calls you do when people come in and kind of inbound into your processes. You say that you might have lost them at that conversation point. If you say you've had a capital that call at that point, they may tune out or not be interested in whatever you have to say. So fortunately, we haven't had to make one, but to that point, that will be, if that ever happens, hopefully it doesn't, but for those who have gone through this, I'd be curious to know what it's like, but it's, a massive objection and kind of a scarlet letter to a certain extent.
Right. So as a sponsor, you want to avoid that, right? You want to avoid a capital call because it can impair your ability to raise equity in the future. So number one, you want to avoid a capital call, but if it comes down to it, you'll do it, right? But maybe to avoid a capital call, you'll pursue less favorable third-party financing, right? Because think about it, if you have to convince outside equity to come in and provide rescue capital, that very well could be at less favorable terms than the capital call itself. And so that could be more dilutive than a capital call. So that could actually injure investors more than a capital call, but a sponsor will pursue that avenue to protect their clear history of not having made a capital call. So that's one example. The next example would be delaying a negative outcome, right? As a sponsor.
Which is that arguably the worst thing to have happen? It's basically just like not facing the music. It's like sweeping something under the rug, right?
A little bit.
Or it could be.
It could be, and it just really depends on the situation. But as sponsors, what do we care a lot about? Well, in turn, our investors care a lot about our track record, which means we care a lot about our track record. And so if a sponsor has a deal that's underperforming, rather than just cutting their losses and selling the deal at a loss or potentially at a very weak IRR, they're just going to hold the property in their portfolio and potentially live to fight another day and maybe sell it at a stronger return later, or just kind of kick that can down the road and eventually realize that exit and post that lackluster IRR on their track record. So that's something to be aware about. And we're not immune to those things, right? We're a sponsor just like all the other sponsors, and we have these same motivations. So I'm just sharing the truth and the realities of these lack of alignment of interest at certain times of these deals. So those are just some of the interesting things on a capital call front.
Yeah, and to extend on that, if one is to do it, because I think another thing as well is setting the right tone and setting the right culture, and from an industry-wide perspective, but also how in the event that we were to do this or it happened, how would you best go about that process? How would you, ensure and regain people's trust, essentially, if this does happen? Because there could be a time at this point, whether it be in 12 months from now, God forbid it happens, but it could happen, to a lot of people, depending upon what happens to the market. So what do you think the most appropriate way to go about that process and scenario would be like in the event someone has to do it, or is, kind of realizing and waking up to the fact they may have to do it?
So it's all about communication, like we always talk about. If you're going to take, even when times are good, you want to over-communicate, right? But especially when times are bad, you want to make sure that you over-communicate and really lay out all the details of the current situation. It's a fine balance because the typical inclination is to sugarcoat, right? But if you're making a capital call, you want to actually describe the severity of the situation. But you don't want to make it sound too negative, because then it's like, well, why are we making the capital call at all, right? If this deal's that bad, why don't we just cut our losses?
And something I think about right now is good news travels fast, but bad news travels substantially faster. So
at least it should.
Exactly. Well, it does, though, unfortunately. I think the brain can really latch to negativity as opposed to the positivity, I think, in many respects. So, yeah. So communicate, get up on it early, maybe not exercise too much caution, but it's kind of a tightrope. And I think another thing to do, and this is why I'm really confident in how we are, is just reporting. On our monthly newsletters, you kind of get a sense of what's going on one way or another: occupancies, move-ins, move-outs, what's going on with the property, financials. This shouldn't just be a random, oh yeah, by the way, we're having a capital call. It's like you should maybe at least have some sense of what's going on with your investment. And if you are an investor that is not investing with us, please feel free to reach out to us, and we can kind of send you what a newsletter looks like, or reporting, and just kind of pull back that curtain, if you will, just because that's how it should be done. If you're with a group that isn't reporting and isn't investing like that, which is really common, especially when I speak to new investors, it baffles me that, people can be in business with their lack of communication, with their lack of systems in place.
Yeah, so that's a great point. And like you're saying, a capital call, God forbid, shouldn't come as a surprise, ideally. Ideally, the reporting is kind of describing the situation frankly and getting worse and worse, and that, hey, a capital call is a risk here. And then finally, when the capital call does happen, the investors were prepared for it because they were keeping up with the monthly reporting, and they can see that, oh, this is becoming a problem and it has to eventually be addressed. And the other part about it is it shouldn't feel like a blank check or like a black hole, meaning the capital call shouldn't be this ambiguous, well, we need $1 million because the property's suffering. It should be, no, we need $1 million because $200,000 is to cure certain deferred maintenance that's going to lead to improved performance, and that's going to help mitigate negative cash flow, and there's light at the end of the tunnel because once we implement these things and fund negative debt service, we're going to be able to get to cash flow break even. We're not going to need any further capital calls, and that business plan has to be clearly articulated.
Interesting. Okay. Yeah, and it's not just like, yeah, there's a capital call that goes directly in the sponsor's pocket. Right. So that's awesome. Another thing that you mentioned a bit ago, because there were so many great nuggets in there, and this is why I love this show, is because we can deep dive into everything on, not really a time stamp, if you will, and in a condensed period. Is you mentioned, wanting to have sophisticated investors. So does that mean accredited investors? And is that also, or is that more of a minimum, right? So for Lone Star, it used to be $100,000 minimum for investment. Now it's $50,000. And unfortunately, what's happened is now people email us a lot of partners that we work with, which we love you, by the way. If this is you, this is not a shot at you, but people say, oh, can you make an exception for $30,000? And the answer is, well, maybe not, and no, because that person, not that we don't appreciate a $30,000 investment, but is that person maybe more sophisticated? I don't know. It's tough. And, we'd rather have fewer investors that can invest more for obvious reasons than a lot of investors giving us, a little amount, right? So I guess just talk about what you mean by, sophisticated. Does this mean accredited, a non-accredited minimum? What is an ideal world for you?
Yeah, I would say, to your point, there is a connection between check size and sophistication, but not always. There are big investors who not necessarily sophisticated or as sophisticated as others. But like you're saying, and it's kind of just the rule of life or a fact of life, is your $500 client could be a much, much bigger headache than your $50,000 client, right? Or in our business, it could be a $25,000 investor is going to ask a million questions and be very uncertain and have a lot of issues as compared to your
I have a story about this
$500,000 investor, right?
So I recently, and I think I laughed about this, oh man, so this is a gentleman who's non-accredited, maybe invests in 2 other syndication, and I don't mean to be disrespectful, and I hope it doesn't come up that way at all, but they told me they had a 40-question list for a sponsor to go through, which I diligently went through. And he said, oh, you're top 5 of the people I've spoken with for sponsors. I'm like, okay, cool. It's like, yeah, top 5 out of 40 groups. He's messaged 40 groups of people. Like, that is an incredible amount of people to be interviewing and asking questions for. I mean, that is a lot to put a lot of groups through, but the amount of questions and handholding this person had to do to maybe scrape together $50,000 to make an investment, which is incredible. The other side of the window is my new best friend, one of our clients, who invested and dropped off, 6-figure checks and, really understood it and was for sure more sophisticated, had a very good sense about him, and you could just tell he's going to be a very awesome person to work with and to nurture and to grow the relationship with and to take care of. But it's funny, as you say, just how that works, where the $50,000 or the $500 client gives you all the headaches, all the questions, and then the more affluent person, just needs servicing and just carries himself differently.
That's a risk too. You don't want to necessarily be in a situation where an investor is investing their first and only $50,000, right? Because that's a risky situation. I mean, number one, that's not diversified, that investment for them. So their portfolio is not diversified. They're taking a big risk on a single deal, even if it's in itself not necessarily a risky deal. Just the fact that they're not diversified is risky, and you better believe that they're going to be hounding you about their investment all the time because it's their only $50,000.
It's only, yeah, exactly.
Right?
They're probably sitting it and watching it. And for the record, please don't think that I don't love answering all your questions. I love it. This just specific situation made me think of the contrast between the two individuals.
Well, I love this guy having a 40-question sponsored
Yeah,
questionnaire. It's awesome.
What I don't love is the fact that we're one of basically 40 sponsors that they talk to, because that's just, to me, a little bit silly.
That's a lot of work to invest your 50K, that's for sure. I mean, the point of passive investing is for it to be passive, right? The point isn't for you to be underwriting a bunch of deals and vetting
And
a lot of
underwriting
sponsors.
sponsors, right.
This kind of sounds self-serving, but the reality is to really get the best value out of passive investing, it's to build relationships with sponsors, establish trust, so that way you can invest repeatedly with the same groups, right? You don't have to just invest with us, but if you establish those relationships, then you're able to not think and have to underwrite every single deal that comes across your desk. If you get a deal from us and you trust us and you work with us, then you make an investment. You have your other sponsors that diversify you. So you get sponsor diversification, potentially asset, strategy, geographic diversification. Those are all really great ways to invest without it becoming a full-time job.
Yeah, and I guess at the same time, I have to remind myself how fortunate I am because, my dad, obviously, a financial advisor, so with my monies there, I don't have to worry about my dad and brother stealing anything from me, and they're incredibly successful in what they do. They're elite, they're top flight at it. And then I was doing residential real estate. I trust myself handling that process and making those investments. And then obviously, you being one of my best friends, yeah, I'm not really worried about my money not going to the correct places. So, I guess it's easier for me to say because I've been in the fortunate circumstance to have the right tools, people, and education around me to really not have to think and overthink and, analyze the situation too much.
Well, how great is it that a bonus factor of our business is that we get to invest in our own deals, right? We get to eat our own cooking.
Yeah.
And all the effort that we put in to finding and doing great deals, we get to ride on that benefit and invest alongside it. So that's amazing because, like we talked about today, investing is difficult, it's risky, and so it's emotional. So if you can, like for us, we just invest right alongside our deals. It's an amazing place for us to place capital.
I don't even think about it. Yeah, like
right.
I really don't think about it. Like it's just like, oh yeah, I know over the course of time, I plan to be in business for forever. Really, I'll never not want to work, and I really hope to look up and the scoreboard says incredible numbers, and I don't really have to think much about it.
And another really cool thing, just to give ourselves a little shout out, is our employees at Lone Star Capital don't pay promote. So that's a super awesome perk that I love. Kent and I, in our deals, we invest just as regular LPs and we pay promote, but our employees don't pay promote, which is a great perk because if a deal is projected at a 15 IRR on a post-fee but unpromoted basis, that might be an 18 IRR. So you're getting a nice boost right there. Already that's a more competitive investment than you could likely make otherwise.
It doesn't, well, especially the stock market's yielding you what, call it just 5 to 8%. Okay, great. Well, if you're getting that in cash flow, that's incredible. And in conjunction to the appreciation plus the exchanging and trading up component with this property, which is great. So I have a question as well. So the property we're under contract for in Dallas, the one where, of course, we mentioned we're at there today, that property, we are buying that for less than what the sponsor bought it for in 2019, which is really awesome to think about on our end, obviously, considering the fact that we have an incredible basis. But their debt profile was a bridge debt. I think it was a 3-year bridge term. Is that correct?
That's right.
So what does that mean? Does that mean that essentially if that debt in that note came due, they would have to do a capital call for some cash infusion here? How would that work? What would be the fundamentals for that specific case study?
Yeah. So yeah, let's unpack that a little bit. So they bought that property in the middle of 2019, and their loan on that deal is just shy of 30 million, right? So let's call it a $30 million loan, and that loan actually matured in August of 2022. So they're currently in the extension period, and their extension expires in August of 2023. So it's coming up, and right now we're under contract to buy this property, and we're looking at agency financing for the deal. So an agency debt, as you know, is constrained based on in-place income. So what that means is the size of the loan that you can get is based on the performance of the property today, as well as, of course, the appraised value, et cetera. But usually you're more income constrained than value constrained. So today, the biggest loan that we can possibly get based on in-place underwriting for an agency loan is $25 million. So that's a $5 million gap between their current debt today is 30, and the biggest loan that we or anyone or they could get on the agency side, which is permanent financing, is 25 million. So if they wanted to go the permanent financing route with Fannie Mae or Freddie Mac, they would potentially have to, it's a cash-in refi, and they would have to fund $5 million of the difference. And that could
Which is basically a sixth of the equity.
Yeah, I mean, we don't know how much equity they brought to the table originally. Right. Probably, I mean, certainly less than what we're projecting.
Well, that's the delta of the debt right there we just spoke about, I believe, yeah.
And so they might have to bring in that $5 million as equity if they chose to go that route, or they could bring in preferred equity or some sort of subordinate debt to finance that gap. So that's a tricky situation for them, and that's likely why they're selling right now in lieu of dealing with either exercising the additional extension option that they likely have on the bridge loan, and also if they exercise the extension, they're going to have to purchase another replacement rate cap, which is expensive and has its own host of issues. What was the other thing I wanted to mention about that? Well, so the other option, aside from doing an agency loan plus equity or agency plus pref combo to get them to that 30 million so that they have enough capital to pay off the existing debt. The other way to go is bridge to bridge, right? And so more deals, if needed, are looking at bridge to bridge financing, which is in a typical market very rare. You typically don't buy a property with a bridge loan and then refinance that bridge loan with another bridge loan, right? Because a bridge loan is a transitional product that usually gets you to permanent financing. So you bridge to bridge only in tough circumstances. And so in this situation, they could go bridge to bridge and probably get the loan amount that they need to pay off the existing loan, but it's going to be expensive. Right now, the bridge market is just extremely expensive. And also a lender's going to look unfavorably at a bridge. Whenever a lender's looking at a bridge to bridge scenario, they're going to price it and be a little bit tougher on the deal.
Interesting, cool. Well, do you have any final thoughts to wrap up on the capital call conversation?
No, I think we unpacked it pretty well.
Cool, awesome. The next concept I want to think about and speak on is time-killing deals. So I think everyone's heard that expression and phrase before, is time kills all deals. Let's kind of unpack that and discuss situations where we've had that happen and whatnot. I mean, I know in my residential real estate business before that, you know, I've had buyers who might get a little hot and emotional on opportunities where, you know, when the market was a frenzy, that they felt their offer was getting shopped, or, you know, the other way around, you know, a counter being out and the buyer not accepting it. You know, time sometimes is your ally, but also works against you. But that's a different scenario. In our world here, how does, you know, time, you know, work for you or against you? And, you know, can you give any examples of, you know, that, I guess, occurring?
Yeah, so time is not on your side in many circumstances. It's on the other hand, it's nice to have time, so that way you're not running through a deal at breakneck speed and really scrambling to raise capital and go through lender due diligence and things like that. But if you are struggling to close the deal and it's getting delayed, as we've had plenty of personal experience, that can cause anything can change, right? You might have locked in some certain debt, but then if treasuries move a substantial amount, that can get your loan repriced, and that can cut proceeds, and then that can in turn affect your return projections, which can then cause investors to back out. I mean, right now we have a deal under contract that is frankly taking forever to close.
Yeah.
And I mean, it seems like I'm getting emails because every day it seems like we're refunding investors their money back, because investors go, yeah, this deal was great, but I've kind of been tired of waiting, and let me just get my money back. So we're sending money back to investors. So time totally kills deals, and when a deal's under contract, every day you're not closing, you're taking market risk because the market may change. And I'd say that really that's the biggest factor.
Well, a war could break out. I mean,
yeah, we actually had that happen. Yeah, I mean,
with Ukraine recently. I mean, frankly, a war could break out. A pandemic can happen. Basically, everything is essentially working against you. But there's also times when the market goes super hot, and it's like, oh wait, we locked in this deal here. This is a sweet deal. But I think, in most cases, I do not think things being dragged out is within your favor. Unless maybe you can, perhaps, and you don't want to make a habit of this, maybe you could retrade or something like that in the event that occurs. But generally speaking, it's not what you want to have happen. I mean, I remember the deal we're currently raising for, the one you mentioned, treasuries were, I think, at like a 3.28 at the lowest, and now they're back to, I think, 3.9, which is tough. I didn't check it today for the 7-year, but I mean, it's a 70 bip delta. That's incredible.
Yeah, I mean, we weren't necessarily going to be able to time that bottom perfectly.
No, but it's just the spread there is pretty crazy to think about.
Yeah, the treasury markets are just so volatile right now. Normally a 20 basis point move in treasuries is a big deal while under contract, but the swings in treasuries have just been nuts lately. So that's especially difficult in today's environment.
Right. Interesting. Is there any examples that it's worked for us or against us at Lone Star?
Well, a couple interesting examples. I don't know if this necessarily worked for us, but interesting stories nonetheless. So in 2022, as things were really starting to get hairy on the capital market side of things, we had a couple deals under contract and 2 different lenders. And funny enough, there was a Friday where we thought we were going to close the next Tuesday, and then on Friday we get a call from the lender saying that they're walking from the deal. And it was just such a shock, and it's ridiculous.
Was this the landing?
No, it wasn't the landing.
Okay.
So we don't have a lender. We're not able to close. We have no idea how we're going to close. This is a complete nightmare. And going back to the market, and this is in 2022 as the market was changing, going back out to the market and getting a new loan was going to be a complete nightmare because terms had completely changed while we were under contract. So we had actually locked in really great debt. And that's how we were able to afford to pay the price that we were paying, right? And then, so we had that issue on our hands. And then the following Friday, we get a call from the other lender, and they backed out as well. And
this is with the Big 1031, right?
Yes.
So, yeah, do you want to continue that? And then also we'll unpack really what the implications are for the other party, because they're probably sweating bricks.
And I just don't want to share too many details, because I just don't know how much we
don't
are able to or want to share. But the story is incredible, and we're dealing with very difficult issues there, and so we're transparent with the sellers and letting them know, hey, here's the problem. We need price reductions in order to be able to proceed, because here's where our debt was, and now here's where the market is today.
And no one wants to have this happen. We wish we closed a couple weeks ago with this debt that we thought we could get. This is not fun, but we're all in this kind of one together. And clearly, if we're having this issue, we're not the only shop in town, and this is a industry-wide problem.
Yeah, right. Because
it's not exclusive to Lone Star.
If they said, well, no, take a hike, we're not going to entertain your price reduction.
Yeah, well, good luck, because you're going to close 2 months later, 3 months later.
Least. Yeah, they're going to have to go back to the market.
Yeah,
go find a new buyer.
Go jump through some hoops.
Right. So it's better to work with the devil you know, right? When
exactly. Well, and that is sometimes the benefit of the buyer. Is like, okay, well, at least you're a little bit more in the driver's seat, unless you have a substantial amount of money there. But the interesting caveat to that is, sometimes what happens when it's 1031 exchange person, where it's like, well, who knows how long that thread of exchanges are, and if that person were to cash in the chips, so to speak, and sell, the recapture on that tax, it would probably make you want to throw up, right?
That's a whole other story. Yeah,
Yeah.
that's something that's can't have happen. So
Yeah.
so we are facing that issue. Went back, and also just to make a comment about retrades, right? Because that's obviously a no-no in the industry. A retrade more so is when you put a deal under contract in bad faith, knowing you have full intention to negotiate the price later, right? That's a retrade. But if you need a price adjustment because of factors that are outside of your control that you weren't previously aware of, nor were you or the seller aware of, then that is fair game, right? You shouldn't get a negative report card for that one, right? So, but just to kind of mention another example, right? If you put a deal under contract and then later claim an issue with the roofs as a reason to retrade, that very well it could be a very poor reasoning because you could have found that out before.
Yeah, that's kind of bush league. It's
You should have known
inappropriate.
that.
Yeah, exactly.
Right.
That's just a little juvenile if you're in the business of doing that.
So with these deals, right, we had to go back and get price adjustments. And meanwhile, we're looking for new loan opportunities. But the magic here was the fact that, like you said, we did have an investor, a large investor with very important 1031s involved. And thank God that we had such an amazing partner and investor on these deals, because this investor would not take no for an answer.
Right. So
And
it's tenacity. Well, then those are good learning lessons. Like, hey, being tenacious and burning, all bridges in that regard to, make it happen and to push through is an incredible lesson to learn, and be on the good side of learning that lesson as opposed to learning the hard way. You learn the hard way, but not the extremely hard way, right?
Right.
So, yeah.
So with that tenacity, we were actually able to negotiate with those lenders to get them back to the table. Now, it wasn't pretty. We actually ended up signing on partial recourse, right? And the number one rule of real estate is not location, location, location. It's never sign recourse, right? And so we were in a situation where it made sense.
You could trademark that right there.
Everyone made sacrifices, and one of those sacrifices was to sign on partial recourse on those loans. And so that got the lenders back to the table at actually good terms, right? Better than what we could have gotten if we would have restarted the loan process and got a new lender. And in the meantime, we also were able to get price reductions. So things kind of in the end balanced out. If not, we even came out ahead a little bit.
It was a little silver lining, a little cherry on top.
Yeah, with a little bit of
going gray
heart
in the
palpitations.
Process. Exactly. Yeah, such is life, right? Very cool.
There's definitely a lot more to that story, but my brain kind of just blocks out the nitty-gritty of the really trying times, because that's certainly not the first or the last time that we've been, walking into the closing without any lender or missing equity or problems, this and that. I mean, it's just amazing what we've been through, and people are always surprised at how little I stress out about things. And I think that's just because over and over I've been through the ringer, and we've just had such difficult things, and time again we prevail.
What has your dad always said about you? You get away with everything.
It always works out for me.
It always works out for you.
Yeah.
Yes.
Yeah. So we're blessed, but so that's an interesting tidbit.
Very cool. Well, do you want to touch any more points on time working for you against you or killing deals?
No, I don't think so.
Okay, cool. On to a more personal note. I think, we all live life, maybe wanted to do a couple things differently, one way or another. With that said, what are some things you would have done differently knowing what you know now?
Yeah, I mean, I wish I had some really...
Personal and maybe business, yeah.
Yeah, I wish I had something more meaningful to share about this.
That's tough for you to say, because what you think is not meaningful might be incredibly meaningful to someone else. So I disagree with that. It's personal. Maybe it's not some long-winded, emotional, sad, sappy story, but it could be something that's like, oh yeah, shift a little bit, or tilt a little bit to make it happen.
Yeah, no, I mean, I'm sure if I thought more about it, I could think of something great. But The thing in business that comes to mind is just my reluctance towards sales and marketing. Growing up, I thought that sales was sleazy and things like that, right?
I know some people think that still.
Sure, and I also thought that, it's honestly ego, and it's kind of like, oh well, I'm really smart, so therefore I shouldn't have to market myself or
It's just
market.
the dumbest thing I could. With all due respect, that is just so stupid. Yeah, respectfully.
So that's kind of how I grew up. That was my thought process. So that obviously doesn't serve you well in business because sales and marketing are critical, right? It doesn't matter how good your product is. If nobody knows about it, it's not going to happen. So for us, both Kent and I had no idea about raising equity and what it meant to build relationships and to scale up and things like that. We totally made that an afterthought, which was a huge mistake. And so thankfully, it wasn't too long that we got our act together, but for sure, I could have been getting involved on the sales and marketing side of things so much earlier and dedicating more effort to it sooner. That's always, I think, a regret, is people can, get on the right track sooner.
Right. Is there anything personal you want to think about on that one or touch on?
I don't know. Maybe you have something to share for me. I mean, you know me pretty well. What's something that I should be regretting or doing differently?
I'll think about that one for you, but I have one personally. You might laugh at this because you did not do this. You definitely left the nest because, I think you mentioned before that you dropped out. Well, great. Now you have to work and you got to make things happen and you're on your own, pal. So I graduated college in 2016 and then I moved back home to the Bay Area to do residential real estate. Knowing what I know now, I would have moved to Phoenix, Arizona, Scottsdale, where I currently live right now, and, had no money, but had the experience of having, a fire lit under you and having to make it happen because I know how my brain was working when I moved there, where I was like, hey, you got to make more money. You got to level up. You got to make it happen. No one's coming here to save you. You have bills coming in every single month. I didn't really have the full bill process. I lived at home. My parents were great to me. I got to the point where I didn't feel comfortable with my mom doing my laundry anymore, kind of thing. And I was like, I also started cooking for myself a bit more. But hey, they pay for the grocery bill. Obviously I pay for some other bills. Obviously, like going out, things like that, and have the credit card and like that. But not having to pay rent and not only that, it can kind of put your brain in a stagnant place and will hinder your growth for sure. So the number one thing that I can think, and this is just my advice to anyone, is move out. Maybe get your bearings straight. If you live at home for a year or two, totally get it. But I was at home for about 3.5 years, and that was probably about 2.5 years too long. And in all reality, 3.5 years too long. I should have just moved directly to Scottsdale, figured it out, and I probably would have made a lot more money and grown a lot more and been very uncomfortable. I know this is a very cliche thing to say, but getting to the point and being uncomfortable is incredibly important if you want to grow and expedite that process.
I couldn't agree more. Totally.
Because you saw what happened when I started doing residential real estate. Like, I was working 7 days a week. I was making it happen. There's no middle ground in real estate, especially residential. It's like either you sell houses and you make money or you don't. There's no salary. There's no just middle tier there. So you have you calculate how much money you have in the bank. You calculate what your rent is and basically your expenses. Your personal P&L. And you look at that and you realize, okay, well, what's my burn rate and how many months do I have? I think I had about 8 months, or maybe 6 months, and I got pretty close to running out. And then fortunately, the universe works in crazy ways. Boom, I was doing a couple deals here, and then it really clicked, and I really got things going, which was awesome. Then obviously saved up a large nest, and got to work here, got to invest in our deals, got to buy my house, but that all would have been expedited. Plus, maybe I would have bought my house 2 years earlier in Arizona and cashed in incredible appreciation, traded that up, and built more wealth there. So, the time is working against you, and to that point, and that's the one thing I would have done differently, knowing what I know now. But from a career perspective, I had very fortunate timing, which we kind of joke about sometimes and talked about tonight. Getting in Arizona real estate, great idea, and then pivoting from that, Obviously, still sell some houses for sure, and work with some referrals, some close things, close people. But getting into this business now, I think, is impeccable timing, and kind of hitching my wagons to Lone Star when we're really about to start to crescendo is really exciting. We're building up, and I feel very fortunate. But that's for sure my thought process on that one.
Yeah, those are both great points. And getting out of your comfort zone, got to move out. Even if where you grew up, or even if home is a great place to be, just getting away.
But that's black tar heroin. It's addicting.
Get away.
It is addicting to be in a comfortable, cushy, homey environment where your parents are taking care of you, giving you love. You almost need to be in the dumps of society and the lowest point to build yourself up and to appreciate that.
Totally. Anything? Do you have anything else for us?
No way to know what it done differently. That's just my big one that I really think about is just leaving that, everything will work itself out, put the work in. I think another thing, and I've been fortunate to do, work-wise, really ultimately what I've wanted to do. But, and we kind of talked about this at dinner tonight, but really, and this doesn't apply to me, but I think this is just a lesson that I've learned and been very fortunate to be on the positive side of, but just being engaged and really liking what you do in your day-to-day from a work-wise. I genuinely enjoy my day-to-day, and if you don't like your work, life would suck. Like, that is a huge component. I mean, it becomes your life. That is a huge component of your life to not be happy about, and to imagine dreading half of your existence, of your waking existence, essentially. If you've got 24 hours in the day, let's just say you sleep 8 hours. That's a lot for some people. If you're a parent, a newer parent, that's probably crazy. 8 hours, you're nuts. I get 2 hours or 4 hours like the person we're speaking to tonight. Crazy. But for most people, 8 hours of sleep, 8 hours of work, 8 hours of play. Imagine if you didn't like your 8-hour workday. That would be terrible.
Yeah, no, definitely. And it goes back to an interesting topic that I think we're going to talk about tomorrow, which is doing what you love and that kind of thing, right? Because that's kind of the other end of the spectrum, and it's also, in my opinion, a fool's errand. And that's maybe a topic for another day, but you definitely need to enjoy what you do, but you shouldn't be seeking this blissful existence where you go to work and it's amazing and I just love what I do, right?
Yeah, I love it. It's great.
Because no matter what it is, no matter how exciting of a job that it seems, right, everything at the end of the day becomes a job, right? So even if it's something you love, like snowboarding or painting or whatever, it's going to become a job and it's work, right? So you should enjoy it, but you shouldn't chase this nirvana that likely doesn't exist. I think
avoiding stress will make you substantially more stressed on the long run, right? Because if you're avoiding, resistance, if you're avoiding situations where you are, looking to have an easier existence, it's gonna become more difficult because, life is difficult. And if you build a callus around yourself, you'll be able to persevere and, make things happen. But, it seems as if the passion jobs, for the most part, aren't necessarily the most lucrative either, frankly. Just to, hard pill to swallow that, So, did you have anything else to comment on that?
No, I don't.
Yeah, that's an interesting point you brought up as well. Well, awesome. Thank you so much for being here and giving us your time. If you made it this far in the show, as always, if you're interested in investing into one of our deals or learning more about Lone Star Capital, please reach out to myself and I'll be happy to sort you out. Final thoughts? Any?
This was episode 4.
Yeah.
Hopefully we can actually start posting these and getting these out. I think what is more interesting is if we can post these closer to when they're recorded, right? So that they're more timely, right? Yeah. And then we can talk more current events.
Yeah, topical. Yeah.
Yeah, exactly. And people can kind of follow along. It's like, hey, we're in Dallas right now. Okay, then what's the next part of the journey and what's going on in the market right now? So the closer it can be to live, I think makes it more exciting.
Yeah, absolutely. Well, once again, thank you for participating, being here, listening, watching if you are, and hopefully we'll catch you on the next one.